All right, welcome to today's webinar, How to Tame Your Investing Fears. I'm Johan, joined by my old college D partner, Tyson Stracks. What's going on, Stracks?
Not much. Ready to rock and roll here. How about yourself?
Love it. Another, I don't know, I feel kind of spoiled. Just another beautiful day here, Charleston, South Carolina.
It's not
The
a
boys are
bad,
fired up. Yeah,
not a bad place to live.
no, it isn't. Just a quick disclaimer here before we get started. Through this webinar, the Hockey Wealth Group does not render or offer to render personalized financial, tax, or legal advice. The information provided, it's meant to be educational. Just trying to help guys and their families with, there's so much bad information out there. I think we can all agree the financial media is kind of a disaster, and one of the big motivators of why we thought, hey, let's put together some of our own content and that's rooted in facts and data, and try to help guys. So that's kind of the purpose here, just to keep it educational. So our goal today that we want to discuss, why we experience investment fear, some practical ways to overcome it. Just want to be clear, you never just want to go into something really blind, right? So we're not saying don't worry about anything, because you certainly do want to be prudent, like do your due diligence before any investment. But just the fact of investing is uncertain at times. Like that's the reason you're compensated and you earn a higher return, and with that comes fear, right? Like that's a part of it. And so we're gonna discuss this a little bit today. But some of the steps, first off, just recognizing that fear is normal, like it's okay. And so with that being said, that's, you want to educate yourself with reasonable expectations, like what is reasonable in the market, short term and long term. So gaining a better understanding around that. Just creating and implementing a plan and strategy that you understand and you feel comfortable with. And then lastly, just keeping proper perspective, right? Like understanding that you're going to make mistakes along the way. That's part of life. You're going to have bad investments from time to time. So you just continuing to learn and improving. So, all right, Strax, you want to kick off first slide here?
Yeah, so let's dig a little deeper here. So obviously, first point, recognize that fear is normal and okay. We all experience fear when we're investing. The human brain is prone to loss aversion, and this is pulled from a really interesting study where they found that losing something is twice as painful as the pleasure experienced from gaining the exact same amount.
I remember many years back, whatever, 20 some years ago, like buying the first stock you ever owned, right? Just
Right.
You remember that first loss you had, and then the first gain you had. I remember in my mind quite clearly, gosh, longer than 20 years ago now, but it's so true. For whatever reason, just like our human brains, the way they're wired, losing does feel much worse than gaining, and that's normal.
Yeah, and as somebody that has made more mistakes than most, I remember those losses a lot more vividly than the gains. So, so many of us have felt the pain of losing money in previous market corrections, and recognize that waiting for the market to crash or decline further before investing is many times a means of running away from our fears. We hear this a lot from people, is now a good time to get in, or should I wait? And it's just very, very common, but you kind of have to think of it that way, that, you're just running away from your fears.
Yeah, and somebody else has a good quote. I wish I could remember on the spot who said it, but they said, far more money has been lost waiting for corrections than corrections themselves.
Yeah.
And that's definitely true.
Yeah. So Seth Godin, an author that's wrote some great financial books here, he talks about how do I get rid of the fear? We like this quote. He said, "This is the wrong question. The only way to get rid of fear is to stop doing that that might work, to stop putting yourself out there, to stop doing what matters." He said, "No, the right question is, how do I dance with the fear?" Which I like that. And he says, fear is not the enemy, paralysis is the enemy, right? So just not doing it, right? Not taking action is the enemy.
It's so true. And then this obviously goes way beyond even finance, right? Just life in general, right?
Yeah.
If there's something that means a lot to you, and so many people, they sit on the couch, right? And they're scared to put it into action. Yeah, great quote.
Yeah. And just before this next slide, I mean, you talked about, well, with this slide, really, because talking about the reliable sources, media,
Ugh,
there's just so much conflicting stuff out there, and it's either
conflicting or flat out bad.
or
I
flat
would
out
argue
bad,
bad.
right? I mean, it's either the sky's falling or we're going to the moon, right? So you're constantly just you know ambushed with that kind of stuff, and you start thinking, well, maybe I should just get everything in cash because obviously it's going this way, or obviously, and it's not obvious, right? So it just reads into this point about educating yourself from reliable sources. So for
Yeah,
many
and that
investors,
was yeah.
sorry,
And I was just going to jump in like that.
yeah,
That's a big reason why we started these
yeah,
webinars.
yeah,
And just a lot of the educational material we put out there in general. It's just there's so much bad information out there. It's so
yeah,
conflicted, and we just we wanted to help and put out some material rooted in facts and real data. And so but we're going to kind of show a couple slides today just in terms of investing. But
yeah. Well, and I think on top of that, of just actually giving good factual information, but also from the perspective of guys that play the game, right? So you're not turning on NBC and just hearing financial malarkey, right? You're hearing great factual information, but on sources and topics that are really applicable to guys playing hockey. So point one there was, for many investors, not investing is riskier than investing, which goes back to that great quote you had there. Point two, the market is not like a casino. Obviously, something you hear all the time, from people that just have not invested or aren't, haven't been doing it a long time. They look at it like it's gambling. Um,
yeah.
Point three, new market highs over time have been the norm. And
Mm-hmm.
we'll go a little deeper in that later, but that's really a strong point to think of. And then four is an awesome quote, just saying, be greedy when others are fearful.
Yep, the old Warren Buffett quote.
Yeah.
Yeah.
I mean, that's so true so many times, right? You want
All right,
to
so
take over here?
yeah. So just quick slide here on um, just that first point, right? So for many investors, not investing is riskier than investing. And again, just to be clear here, like outside of the scope of what we're trying to share today, but like there are times, especially like for any kind of short term things you have going in your life, like you don't want to be investing, right? If you need cash for a down payment on a new place, right? Like, or a car you're going to be buying in the near future, right? Like any short-term objectives, that they shouldn't be in the market anyway. But I guess, the point of some of these slides is, reaches a point, especially some longer term assets. Maybe you're trying to plan to bridge that gap from when you stop playing to when the pension kicks in, and we just want to share some of this kind of longer term data, back to Seth Godin's point, right? Just so you're not paralyzed with fear, right? Because inevitably there's going to be market ups and downs, and if you can reach the point where you have those reasonable expectations and you can kind of embrace that uncertainty and volatility from time to time, in the end, you're going to do just fine. So first slide here, again, just that point. For many investors, not investing is riskier than investing, right? So Eric Nelson had a little study, actually a little paper he wrote called "Learning to Love Volatility," and so he asked the question, well, which is safer, a short-term bond fund or a diversified stock mix? Okay, and in this study, what he did, okay, he took a 25-year period from 1995 to 2020. All right, so not exactly like a terrific time to be investing, right? You had obviously the dot-com crash, right? 9/11. You have the financial crisis, 2008-9. So a lot of volatility in this time period. And so which is safer, a short-term bond fund or a diversified stock mix, right? Now, the bond fund over that 25-year period did not lose 1% in any single month. All right, so very, very stable, really never goes down. Where on the other hand, you can see in that 25-year period, a diversified stock mix had 7 episodes where it lost 20%. And in fact, during that financial crisis, dropped nearly 60%. Okay, so I don't have enough room on the screen to show the whole study, but what he said, so the 2 investors, and they each put in $1 million, one into the short-term bond fund, one into the diversified stock mix. And then again, in this hypothetical scenario, that this $1 million, each of these investors, they were taking out $50,000 a year for income, right? Pulling out of the portfolio. And okay, so the person in the short-term bond fund actually runs out of money, okay, before you even get to 2020. Okay, that portfolio goes to zero in the year 2019. Whereas the person with the diversified stock mix, even with these 7 episodes of 20% losses, one time period where you lose over half your money, that portfolio after 25 years, 5 million plus sitting in the portfolio. Okay, so point being, a short-term bond fund is indeed safe if the goal is the return on your principal a few months later, right, or in a year, right? And that's where the short-term bond fund is very appropriate, right? Again, if down payment on a house or a car, any kind of short-term expenditures that you see in the near future. However, like that bond fund is incredibly risky if you have a time horizon greater than 10, 15, 20 years. So just really, really important to kind of distinguish the difference in risks. And one thing we see at the office a lot, and just a misconception, right? Avoiding losses is not a financial goal.
Very, very true.
Just another, I don't know if you call it a myth or a misconception, but this notion that the stock market, is a casino. Just the data doesn't suggest that. All right. So what we have here on the left, the odds of winning various casino games. All right. So, like blackjack there is 44%, craps, 48. What do they call that? That 3-card poker. Roulette is going to be on there. Yeah, I think Roscoe on the slot machines. Yeah, that might be the 23%, but just pulling the lever all day. But you can see, obviously, the odds of winning various casino games, right? They're all less than 50%. That shouldn't come as a surprise, right? Or that if there's ever a game that is over 50%, like you're not going to see it in the casino, right? Like in the long run, the house wins. All right. So those are the odds of various casino games. All right. So what we show on the right here is your odds of winning in the stock market over different time periods. Okay, so the first bar, if you can see, so 1 year. So in any one given year, historically speaking, over the last 120 years. That's a pretty long data set. In any given year, 73% chance that you'll gain money in the market, and then you notice each additional year, or the longer the time period, right? So 3 years, 5 years. If you have a 5-year holding period, close to a 90% chance of increasing your wealth. 10-year, 15-year, you're at a 99.9% chance of gaining wealth, investing, or in other words, not losing. So you're just pretty obvious making the case here. Anytime you hear, the stock market is a casino, you can say, maybe look at some better data.
Right. I would jump in and make one point and then tell a quick personal story. One point, there is for the gamblers out there that are yelling at the screen, there is a game at the casino that's in your favor. I think it's called Pai Gow. And you know how the casino handles that is that they take a rake. So I think it's like 52-48 or something. I don't know exactly, but I should. I lived in Vegas, but so the one game that's in your favor, then they just take money every time, kind of thing, to make it back in their favor. But on this slide, obviously you see the percentages once you start going out long term. And to kind of go back to what you were talking about earlier, Johan, about, I mean, you didn't mention kind of the buckets approach, but talking about short-term stuff, right? Like you shouldn't have money invested in the market that you might need in the coming years. And that's a really interesting, for most people, they kind of have their retirement date in mind, right? So as they approach that, get safer with their investments, obviously, right? But not many of us as hockey players get to kind of end our careers on our term, on our terms. So we kind of always have to know that that's, could come at any unexpected time. And I got into a situation where it wasn't necessarily just that I invested in concentrated bets on, certain things, but I put too much money into it, right? And then, with the thought that I had 3 more years, 4 more, 5 more, whatever it was, right? And then it ended up being kind of the last year that I earned, the bigger paychecks. And, I'm in some stuff that just went down, and then all of a sudden I needed that cash. If I could have held out long enough, which goes back to putting too much in, those actual stocks would have probably made me some money in the long term. But I mean, a big one is that in the alternatives world, that's where things get scary, and we try to steer people away from those mistakes, because I put money into a REIT, and was basically, the way it was sold to me was guaranteed that it was going to liquidate within a certain period, blah blah blah. All of a sudden, 3 years later, 4 years later, 5 years later, it's not liquidating. I'm now retired from hockey in that transition period, and I'm not getting that cash, right? So
Right.
being careful about kind of what you're investing in, where you're locking up the money, and making sure that you always have enough that's not in the market, right? That for those short-term kind of goals.
Yeah, that's a great point. Yep. So like liquidity is huge, right? And we see it all too often with other hockey guys just getting sold some of these
Yeah.
whether you call them alternative or illiquid, whether it's a non-publicly traded REIT,
Yeah.
or some other longer term projects. You want to be really careful. And then the second thing is just the other thing that in terms of the probability of earning money, of your accounts going up. Again, these are diversified portfolios, right? So they're using the Dow Jones here. If you're buying like a single stock or some kind of cryptocurrency, obviously you might not expect returns as consistently higher. So
But, yeah. And I
worth
think you could tell
pointing
from
that
my
out.
story, I was not buying a nice diversified, ETF. I was making some concentrated bets and was too excited about it and went all in.
That was before you started learning some things, Strax.
It very much so was. It was. It was one of those lessons.
Yeah.
Yeah.
All right. Next here, just understanding that new market highs over time have been the norm. All right. So, and obviously we're not hearing this as much in the office now, but a handful of years ago, right when the market's hitting new high after new high after new high, it's like, oh, do I really want to invest when the market's at an all-time high? And uh, some people just don't understand that. Yes, like although there is going to be again inevitable market corrections, like regardless of the state of the economy, companies are always going to try to improve profits, right? So in every, I always just kind of visualize in my head, like in every Fortune 500 boardroom, right? Like every one of those boardrooms, they're coming up with strategy like how can we improve our profits and make more money, right? And as an equity owner, right, if you own stocks or diversified portfolio, right, you have a fractional share of all those profits. So until the time comes where all those boardrooms, they just throw in the towel and say, oh, we don't care about making money. Obviously, I'm being facetious that's not going to happen. But as long as that's the mindset, like you should expect in the long run for those profits to grow and for stocks to grow over time. Okay, so that's just kind of a perspective to keep in mind.
Yeah.
All right, and the old Warren Buffett quote here: "Be greedy when others are fearful." I mean, not hundreds, thousands of examples that we could throw in here. But yeah, so here, December, the example on the left, December 1994, huge headlines: Mexican government devalues the peso. The world's ending, and then 10 years later, the Mexican stock market 443% higher. All right. Argentina defaults December 2001. Sky's falling. Oh, wait. 10 years later, it's up over 1,000%. Right. I mean, we could pick any number of these, but I
Yeah,
like
there's
stacking my chips
endless
with
endless
Warren Buffett,
examples of it, obviously. It's I mean it's
even
just
the
not
US.
yeah, the US. You like we're 15 years out from the financial crisis, you're 300% plus up, right? Like
Yeah,
it's
easily.
it's the way it is. And in these times, it goes back to that thought that the losses are so much more painful, right? So people are fearful and you know everybody's a very good investor with 2020 vision looking backwards, right? You always hear people say, well, that was obvious. But if you really went back to that graph of the all-time highs, and if you just kind of think back through the years, you know there's things like COVID that are going to happen out of nowhere that actually have some effect on it. But there, every day in the news there's some story that's going to make you think that, well, of course the market's going to drop off tomorrow, or the opposite, right? Or of course the market's going to take off. And it's just those things are out there constantly. And like you said, these boardrooms are full of people just trying to constantly solve those problems and figure out how to be profitable.
Yeah,
So staying
exactly.
invested is the way to go.
For the assets that should be invested. And again, we can't harp on that enough. That's why it's just so
Correct.
important. A nice little segue into this slide, but just why you need plans and strategies in place.
Yeah, exactly. So talking about creating and implementing these plans and strategies. So if in earning years, automating weekly and monthly contributions, it makes great sense. This is called dollar cost averaging, it can remove regret about timing the market wrong, right? If you come into a lump sum of money, and this is something that we, get asked about all the time. People say, do I put it in right now? Do I try to wait? Do I try to wait till the timing is right? Or do I dollar cost average, right? But it's easy while you're earning just a specified amount out of each paycheck in kind of takes it takes that thought process out of play, correct? Like,
Yeah, and just really nice. Yeah, when you're in your playing years and you're earning good money, like just the way dollar cost averaging works, right? Because just by putting in a fixed dollar amount, whatever it's per paycheck, whatever that number might be, right? Like if the market happens to be lower, like you end up getting more shares, right? If the market's trading at an all-time high, you're not going to buy as many shares at the higher prices, right? So it's a really nice systematic way of investing while you're in your earning years.
right. We talked about this. I just kind of mentioned it a little bit earlier, but using the bucket approach, right? And these are not real buckets; these are mental buckets. But you have a safe bucket, that's kept for those short-term needs, and that's what we were talking about earlier. Again, a longevity bucket for those longer-term needs. And then you can have kind of that third bucket, a speculative bucket for some riskier opportunities, right? That's going to be, a smaller amount, obviously, and something that really you're okay putting into these riskier things that, you'd be over the moon if they took off, but you're not going to crush your financial plan if they don't, right?
Yeah, exactly. And for some people, for some guys in their families, like that, they don't even want the speculative bucket, right? So definitely not for everyone, but
Yeah.
yeah, just from experience, some guys like the kind of those lottery ticket opportunities
Yeah.
in
Yeah.
venture capital, or maybe if they really think some coin is going to the moon, right? Like you used to say, Strax.
I've heard
Like
way
yeah,
too many,
maybe you
way
could
too
set
many
aside
people talk about that. The
uh, to the moon.
speculative coins going to the moon. Yeah, been in too many locker rooms hearing about that. I don't like it. But then this last bullet here talking about implementing income guardrails.
Yeah, and it's the guardrails is for a lot of the guys and families we help. This is just a wonderful strategy outside of the scope of today's little webinar here. But income guardrails are wonderful because it's an investment process designed to give you the highest monthly income without jeopardizing your retirement. Right, so it tends to be a great fit for like right when you're getting close to retirement from hockey and you need a plan to bridge that gap, to safely bridge the gap financially until at least the pension kicks in, age 62 or whenever you start taking that. Really nice process where it clearly defines, like, here's the safe withdrawal rate, through the ups and downs inevitably in the market. So really nice. A lot of guys like using the income guardrails.
Yep.
All right, so just to kind of summarize and some action items today. Again, just remembering fear is normal. It's okay. Just continue to educate yourself with reasonable expectations from reliable sources. Be really careful with the financial media. Create and implement plans and strategies that work best for you and your family, and keep proper perspective. Like Strax shared, kind of earlier in his career, and we see it with a lot of guys. You make mistakes. It's a part of life. Continue to learn from those and improve, and that's what it's all about. So
We're gonna have to do a future webinar just to cover all of Strack's mistakes. But like you said, it was you know, a big catalyst really into me coming into this, right? And getting that kind of fire lit under me where I wanted to learn more, and wanted to get in and help people try to avoid some of those mistakes. So on that point, thank you everybody for joining us. We're going to be doing many of these, you know, and try to cover lots of different topics, like you said, with, you know, nice educational content, and, you know, focused on topics that obviously we know as former hockey players, guys are thinking about and should be thinking about. So thanks for doing this with me, Yogi.
Yeah, yeah, absolutely. And of course, we'd love to be a resource. Feel free to reach out to us, whether it's investments or, guidance on pensions. Really easy to get a hold of us, info@hockeywealth.com, or, you can cruise around our website a bit, learn a little bit more about what we do. So again, appreciate taking the time, and we'll talk to you soon.